So what we're going to do today is we're going to dive into a little bit more about cost segregation. Again, Isaac here. So Isaac's been in the business for a minute. He's not your typical tax advisor. He's a visionary in the world of real estate taxation. He's a seasoned cost segregation expert advisor, and he's made it his mission to help property owners reduce their tax liabilities while creating meaningful connections. In general, we've gotten to know Isaac. I was actually Isaac. I think I was on your first podcast that you launched. Uh,
Yes, you were. That was incredible.
yeah, it was a really good one. Good way to launch. How's that going, by the way? Pretty good.
We just finished up the multifamily series. We just launched today, episode number one of the hotel series.
Oh,
So a
cool.
different asset class,
I
but it's
love
going
it.
well, thank God.
I love it. It's a good show. So you guys check out his show,
Name of the podcast is Stage Debate. Stage
Stage
Debate.
Debate. Yep, that's right.
Definitely
I
check out
remember.
episode number one, by the way, of the multifamily series. No, Garrett had a lot of, I still remember that episode. We talked about boosting NOI, and Garrett had a lot of good points. So guys, definitely tune in.
Isaac, just like to kind of set the foundation and the groundwork here, can you explain what cost segregation is in like super simple terms?
Absolutely. But first, I want to take a minute and give a thank you to Nighthawk Equity, Garrett and team for putting this together. Anybody that's on this call, obviously, you have somewhat of a connection to Nighthawk Equity, and there's a dime a dozen when it comes to syndicators in today's world. But it's not a dime a dozen when it comes to good syndicators who have their investors' interest in mind every single step of the way. Garrett and team are smart folks. They do beautiful deals. I've had the privilege to do some of their deals, do some cost seg work. A lot of folks know these guys. They have a tremendously good track record on investor capital. Very transparent. So that's coming from me, and you guys should just know that. And I think you know that already, but I'd like to highlight that. So thank you, Garrett, for inviting me on today. Cost segregation, I would say up until a few years ago, was always looked at as dessert. It's just like a side benefit, like why not? It doesn't hurt, might as well get some tax deductions. And recently, part of my mission was to really help syndicators understand how not only is it not dessert, it might not be the entree, it might not be the main course, that fat good rib steak, but it's a solid appetizer. It really does a lot to the deal in terms and benefits the syndicator, it benefits the investors, and we'll definitely talk about that today. But like Garrett said, let's just talk about cost seg and what that is. So the parable I always give is as follows. I see you in the street. I see Garrett in the street, and Garrett says, "Hey, Isaac, what's up? You borrowed $100 from me a few years ago. You never paid me back." I'm like, "All right, that's definitely true. How would you like your money? Would you like $10 a year over the following 10 years, or would you rather $30 year one, and then let's say it comes out to $7 the following 9 years?" So Garrett's a smart man, and most people would say the same thing, that I want as much money as possible up front. I'll buy some pencils on Amazon, flip them, and make some money, right? A dollar today is worth more than a dollar tomorrow. In short, that's what cost seg is. But I want to backtrack for a minute. So every property is entitled to something called depreciation. You buy a multifamily property over 27 and a half years, almost the entire purchase price will be divided, and you'll get a little bit back every single year as a tax deduction. Because even though a big reason that we're all involved in the real estate space is because properties appreciate, they go up in value, the IRS, the government, they view that your property is going down in value due to the fact that it's older. So you really benefit from appreciation and depreciation. And that's the difference between investing in the stock market versus real estate. Because in the stock market, technically, let's call it appreciation, your stock goes up, but there's no depreciation. In real estate, you get appreciation and depreciation. So you'll divide the purchase price net of land over 27 and a half years. Every year you'll get a deduction. For commercial, it's over 39 years. Cost segregation, what it does is, I like to call it depreciation on steroids. Instead of taking your depreciation over time, you get to take a big chunk, let's say 20, 30% when it comes to multifamily, sometimes a little more, sometimes a little less, depending on the situation. You could take that up front. And by taking that up front, the owners can offset the NOI of the property. They can offer whatever percentage you have in the deal if you're eligible for this depreciation, which sometimes you are, sometimes you aren't, you'll be able to get those write-offs, which actually, and I'm assuming we'll talk about it, can entice you to write a bigger check. Because if you think about it, if you write a $300,000 check to Nighthawk Equity for their deal, but you're getting a $100,000 loss, so you're not really all in for 300K. You're all in for 300K minus the $100,000 loss, which might equal out to 30, 40 grand. So you're really all in for 260. So now maybe, hey, I could write out a $340,000 check. The idea is you're accelerating depreciation. You're taking your depreciation up front, a portion of it, not the entire thing, and it's strictly a time value money play. Let's go ahead and see what I can go ahead and do with that extra cash that I have in my pocket today.
So can you talk about the bonus depreciation? Like, where was it in years prior? Where is it now? Should people still look at it as a big benefit compared to where it was when we had 100%? Like, talk about that a little bit.
Absolutely. So what happened was in 2017, September 2017, Trump decided he's implementing 100% bonus depreciation. And what that meant was as follows. Up until September of 2017, let's say you did a cost seg in June of 2017, you'd be able to accelerate certain components in the property to a 5 and 15-year bucket. Every property is made up of three components. You have structure, which is over the longest track of depreciation. Then you've got land improvements, which is parking lots, landscaping. That depreciates over 15 years, which is a faster track. And then you have the 5-year components, which is chandeliers, flooring, carpet, special electrical. That depreciates over 5 years. You were always, for years and years, for tens of years, you were able to accelerate depreciation from 27 and a half or 39 year, depending if it's residential or commercial, to the 5 and 15-year bucket. Trump instituted in 2017, September of 2017, that you could take all 5 and 15-year components on year one. So it's really like, let's call it the conveyor belt. First of all, you turn it into 5 and 15-year components. Once it's classified as 5 and 15-year components, then you can take all of that year one, as opposed to just taking it over a 5-year or 15-year period. Taking it over a 5 and 15-year period is very advantageous, but obviously taking everything in year one is even more advantageous, because the more the merrier. What happened was in 2017, it was instituted, 2017, 2018, 2019, 2020, 2021, 2022, you were able to take 100% of what you find in year one. In 2023, January 1st of 2023, that went down to 80%, which means that if, let's say, you buy a property for $10 million and we find $2 million of benefits, of 5 and 15-year benefits, of the 2 million, up until the end of 2022, you can take all 2 million year one. Starting in January 1st, 2023, you can only take 80% of that 2 million year one. The remainder usually got like divided and allocated over the following years. In 2024, that went down to 60%. 2025 went down to 40%. 2026, it's slated to go down to 20%. 2027 is supposed to phase out, and it will go back to prior to September of 2017, which it's still advantageous to do cost seg, but you're not going to be able to accelerate anything to year one. One thing I'll add and say is that Trump just announced, I forgot one of these speeches that he gave to Congress and to the House, that he is bringing back 100% bonus and it will work retroactively to January 1st of 2025. That being said, somebody closes a deal. Garrett closes a deal today, does a cost seg. And right now we're at 40%. 40% of what we find you can take year one, if Trump brings it back, and he will bring it back because he makes things happen. So it will happen. Then retroactively, you'll get that 100% bonus depreciation. And if you file taxes already, then it'll come back to you in the tax year of 2026. Maybe they'll give you a refund. I don't know exactly what the structure will be. But just to reiterate one more time, because it's a confusing topic for if you're not involved in it all day. The idea is you close a $10 million deal and we get 2 million year one or more, but let's say 2 million for argument's sake. 40% of that 2 million, you'll be able to take year one. What happens to that remaining 60%? That will come to you, most of it in years 2, 3, 4, and 5. So a lot of syndicators these days are letting investors know that it used to be you could get, let's say, X amount per 100,000 invested. Now you'll get that same amount over 5 years. You won't get it year one. That's how bonus depreciation works.
Yep, exactly. So So yeah, people get confused by that, but it used to be that you could take the majority of it up front, year one, and then you would carry it forward into future years. Now you just take a little less up front, but you're still getting it in years 2, 3, 4, and then 5, depending on how long you're holding the investment. So that makes a lot of sense. But it's just explaining that. I mean, I don't think everyone really understood the 100% bonus versus 40. It's not too much different. It's just the timing of it. Uh,
Absolutely,
yeah,
absolutely.
yeah. So as far as this depreciation goes, who can take advantage of this?
So this is probably the most important topic when it comes to cost segregation, because and to the crowd, and we have 32 participants. This is not a question that every single syndicator would ask on ear because ultimately it could hurt them. Because there are investors, and I think that Garrett is a transparent guy, and that's why he's asking it. Ultimately, you could have an investor, you could have 20 investors on a deal, 30, 10, doesn't matter. So let's say we have 20 investors on a deal. 10 of them are doctors and they're on their W-2, they're making 800 to $1.5 million a year, and they want to invest passively. Then you have another 10 guys that own their own properties or they do construction and they have some extra money and they want to invest in other GPs deals, see how they do their deals, whatever it may be. The 10 people that are in construction, acquisitions, own real estate, they qualify for something called reps, real estate professional status. They can benefit from the depreciation against their ordinary income, which is completely amazing, right? If they want to reduce their tax liabilities, this is the number one way to do it. That doctor, though, that's on a W-2 and he invests 100 grand into Garrett's deal, what's going to happen is if he's not a real estate professional, which generally he won't be, maybe he can make his spouse into one. There are ways to maneuver. You got to speak to your local Orthodox CPA about it. Maybe he could somehow maneuver it, but assuming that he can't, he'll only be able to use the depreciation against his passive income. So let's say he's making a lot of passive income from his the syndicators that he's investing in, maybe some stock market proceeds, or maybe somehow he has a side business that's considered passive. He can use the depreciation against that, but against his ordinary income as a doctor, he won't be able to offset that. And that's why I would say throughout my day, the topic that I'm in touch with the most is real estate professional status. I have GPs calling me, hey, this investor is not a real estate professional, but he wants losses. We'll get onto a call with his accountant and say, hey, is there any way to make his spouse into a real estate professional? Generally, if your spouse is working a W-2, that's sort of a contradiction to being a real estate professional. But again, if you're making a lot of passive income, you can always use passive against passive. So depreciation will be able to go against passive. I had a client that I just did a deal with, and I always ask because I'm a transparent guy. I said, hey, I think you're a W-2 guy. Like, I don't think you're gonna be able to benefit from this cost. Like, he's like, no, I'm making $200,000 this year on passive income. I don't want to pay my 30, 40, 50, 60, $70,000 to the IRS from that. I'm going to do a cost seg and offset that.
Yep. Yeah. So essentially the way, people that if you're working a high paying W-2, it's going to be difficult if you're not in the real estate industry to clock 750 hours, which is the requirement to get your rep status, right? And then so you have two paths here. Either you have rep status or you don't. If you don't have it, you can use it against your passive gains, like Isaac said. If you have rep status or your spouse has it, you can use this depreciation to offset your ordinary income and capital gains in addition to your passive gains. So the rep status is very important if you want to tap into that. But if not, you still get a nice benefit over your passive gains that you may have. Again, that's like if you own your own rental properties and you want to offset some of the cash flow there, or even if you sell it. It depends on what your CPA, and I'm not a CPA, obviously, and neither is Isaac, but whatever they tell you that can qualify as passive gains, you can cover that up. If you have rep status or your spouse, which is more common, then you can take it against ordinary income and capital gains. And so this is effectively how people don't pay taxes. If they're in real estate legally, they're not paying taxes. I'm one of those people because I'm in this full time. So I have rep status because I'm doing this more than 750 hours a year and I qualify. So now I can own real estate and then use it to offset my ordinary income and capital gains, right? And so if you have a job or your wife, one common thing we see is the wife is maybe like a real estate agent or something like that, and then she would qualify. And it's a box that your CPA checks that says he has rep status. And then any of these investments, the depreciation can work against ordinary income capital gains because she was a real estate agent, did the 750 hours, got the checkbox from her CPA, and got to take full advantage of this situation. But either way, we don't like in our business, we really, I say we more advertise the cash on cash returns and the equity multiples and the IRR stuff like that, like of the deal. And then this, depending on how you take advantage of it, is another bonus for people, but it can be a big deal. So this is a scenario like I'm in, but a lot of people will do is they'll invest in like 3, 4, 5 deals and they create a pipeline of deals. And so we'll talk about this in a second, but when one sells, you don't have to eat all the tax recapture because you have other deals stacked up. And all of these losses are carry forwards. So if you, let's say you invest in a deal this year and you get 40% bonus depreciation, that will carry forward in the next year. If you don't use it, you don't lose it as long as you're still in that deal, which I think is important to know as well.
Well said. And I just want to chime in for a second. So Garrett said something very important. This is how a lot of folks how they get out of taxes legally. Um, Trump put out some sort of tweet years ago that he paid I don't know if he put out a tweet or somebody put out a tweet about him that he paid $750. Yes, under $1,000 to federal income tax that year. And everybody was up in arms. Oh, another Trump scandal that he beat the system. Trump did that by doing 1031 exchanges and cost segregation. He owns real estate. He took advantage of those losses and he was able to offset his federal income tax. This is how the rich don't pay taxes. This is how we get out of it. And if you have that ability to do that, get involved. Absolutely.
There's a good question over here. Can you do a cost segregation retroactively? So like do a cost seg in 2024 for a property that was acquired in 2023?
Absolutely. So this is probably one of the biggest misconceptions in the cost seg world. They think once you started straight line depreciation, once you started taking that $10 from me year one, you can't go back and take a bigger chunk retroactively. And that's completely false. I would say 50% of the work that our firm does are look back studies. We get a client and he's like, oh my God, I didn't know about this. And I could go back and do it for properties I purchased earlier. The way it works is you don't even have to amend taxes. Let's say this year, right now, you're filing 2024 taxes right now, and you purchased a property in 2023 or 2022, you never knew about cost seg. We can go back, you don't have to amend it. We could take those losses and push it forward to the current tax year. All you need is a form. It's called a 3115. It's a change in accounting method. We provide it free of cost, and it takes a second to fill out. You push those losses forward. We could go back to September of 2017. That's when bonus depreciation was implemented. Technically, we could go back even farther than that, but generally it doesn't pencil. It doesn't make sense in terms because there's no bonus depreciation. So unless you bought the building for $30-40 million, it generally wouldn't make sense.
Yep. Right. So there's also like these are strategies again that people use to not pay taxes, but there is something that should be mentioned. That's what happens when you sell a property that you've taken depreciation in.
Absolutely.
Talk about that, Isaac.
Absolutely. So Garrett's referring to depreciation recapture. People ask me all the time, every good thing in life has something bad to it. The good food kills you. The alcohol can be bad for you. Any good thing, there's something bad. You go on a fun roller coaster, you feel nauseous afterward. What is the downside to cost segregation? I don't like calling it a downside. I just call it irrelevance. It's just not applicable. And that's if you're going to sell the asset in a very short time period. There's something called depreciation recapture. Let's start talking for a second. I'll give you an example with a 1031. The way a 1031 works is that you get to kick the bucket down the road so long that you keep exchanging that property. The second you sell that asset without exchanging, ultimately that capital gain that you were able to defer will come back to you. Now, many folks won't say that it's bad. The reason why they'll say 1031s are bad is because you pick a bad asset because you're rushed. But in terms of kicking the bucket down, kicking the can down the road, okay, I'll pay my capital gain in 3 years. I'd rather do it then than pay it today. So too with cost segregation. Cost segregation is not wiping away your tax liability. What it does is it kicks the bucket down the road. Ultimately, when you sell that asset, the tax deduction that you took will come back to you. Now, the reason why people still do it is because, not still, the reason why I would say 90+% of owners are doing it is because it's a time value money play. see if I would see you in the street and say, hey, pay me X amount of dollars, which is not a high ticket item cost, that give me 5 grand, pay me 5 grand, and I'll help you kick the tax liability down the road by 3 years. You would say, absolutely. Why not? I could go ahead and have an extra 100, 200 grand in my pocket. I can make a 10% or 8% return, whatever you want to say, which is a lot more than the 5 grand. So the idea is you're really just kicking the bucket down the road. Now, I tell folks all the time, if you're holding on to the building, to the asset for a year or less, ultimately you're not going to even benefit from the tax deduction because you're maybe kicking the bucket down the road by one tax season. By the time you get ready to invest that money is 7 months later, and it comes back to bite you 3 months later. So technically it wouldn't make sense. But if you're holding that asset for at least 2 years, you kick the tax liability down the road by 2 years. And when that depreciation recapture comes back at you, yes, you'll have to pay it back. But ultimately, what you just did is pay my bill in 3 years as opposed to paying today. And what's my ROI of having that extra capital in my pocket today? And one more thing I will add is that depreciation recapture, some of it is captured in the context, and it's considered capital gains. And therefore, that's maxed at 25%. So even if you're an Elon Musk paying the highest bracket, it's maxed at 25% tax bracket, as opposed to regular depreciation when you took it initially can go against 37.5%. So if you're a high income earner, there could be a swing. But even if there is no swing, ultimately what you're doing is just kicking the can down the road and using the extra capital to produce more income today.
Yeah. So realistically, it's something you got to pay attention to. And on a, you should go and talk to your CPA about exactly how that would look, because they're going to be able to tell you, like, hey, when this does sell in 5 years or whatever it is, what is that going to look like from a recapture standpoint? Again, the offset to that, if you're using it now, if you don't use the depreciation, it doesn't do anything, right? It's not going. There's nothing to do. Now, if you use it, then you want to make sure that you understand what that looks like later down the road when the property does sell. But if you've stacked other investments behind it, you may not even feel the impact of that, which is what we do. I keep a pipeline of investments. So even if one or two sells, it doesn't matter to me. Like, it's like, okay, it just gets swept up into the other deals that we have. And so you see a lot of people do those. They'll stack their investments. They'll make 50 or 100K investments multiple times in a year. And then they'll do it again, and they'll continue that pipeline. So the bigger the pipeline is, the less the chance that you get wrapped up into that stuff as well. But it is something to pay attention to.
Absolutely, absolutely. And I definitely like that model as well. It's a very important point that you can go ahead and use your stacked investments to offset the depreciation recapture on the initial one that sold. Absolutely.
Yep. Yeah. So the way we do cost segregation is we're engaging a company, Isaac, over here. We'll engage him to go, and what they'll do is uh, they'll send out some engineers, typically to your site. They'll check for things. But why don't you tell us a little bit more about your process, Isaac, as to, like, all right, we engage your firm to help us save on taxes. Then what?
Absolutely. So Garrett engages our firm. We go down to the property, and we really walk the property and look for any items that are considered non-structural or land improvements. So obviously we've been doing this a long time, so we're pretty well equipped and we know what we're doing, we know what we're looking for. And I just want to I just want to give you a background even before we dive into this. I have clients all the time that call me up and they're like, "Hey Isaac, how come this property got more depreciation than the other one?" They're fairly the same. I'll say, hey, I look at the properties. This one has a pool. This one doesn't. A pool is considered a 15-year component, and it's considered land improvements, and you get a tremendous amount for that. So no two properties are created equal. Every property is going to have an extra light bulb, an extra this. One property is carpet, one property is vinyl flooring, one property is hardwood flooring. Hardwood will get less because hardwood is considered structural. It lasts longer than vinyl. So when we go to the property, what happens is we're looking and going into all the units and going into the common places and going into the outside areas, seeing how many parking spots there are, how much of the purchase price can we allocate towards pavement, which pavement's considered a component that you can take faster. So what we do is we go there, we look through every single nook and cranny, we come back here, We speak to our engineers, they look over the footage and they document everything. And then what happens is that we take the purchase price and we break it down into percentages. How much goes towards this? How much goes towards structure? How much goes towards land improvements? 5-year property, which is chandeliers, flooring, lighting, windows, doors. So once the engineers come back, they draft a report. The CPAs look it over. They make sure everything is completely in sync and everything makes sense and everything was accounted for. Um, and then we send the client their 80-page documented report. If he's a syndicator like Garrett is, some folks are, some folks aren't. They plug it into their clients into their investors K1. So they bring it to their accountant. Each K1 will show not only what you received in terms of distributions, but also in terms of losses. Everybody goes home and is very, very happy.
Cool. Isaac, can investors use self-directed IRAs for tax benefits?
So self-directed IRAs, obviously they could use that to invest in deals. It gets complicated. Most of the time, it's not an issue. Like I always say, you got to speak to your CPA when it comes to like these nitty-gritty stuff. But self-directed IRAs generally can be used for tax deductions.
Got it. When is the best time to do cost seg?
So this is getting into a hot topic, and this is something I'm very, very passionate about. A lot of folks say, "Let me just do it before tax season," because like I don't have to deal with it right now. Technically, you're completely right, but when it comes to multifamily value add, what happens is that ultimately you turn units. Some people do heavy lifts. Some people are doing just lipstick on the pig. Um, what's going to happen is if you're doing a heavy lift, you want to get in prior to the heavy lift because all the components that you're about to throw in the garbage, the IRS says you deemed it worthless. Why should we give you benefits from them? So you threw out the old flooring or the old kitchen stuff. If we capture it, if a cost seg firm captures those components before you throw it in the garbage, there is that gray area in the IRS code that you could go ahead and account for that in your depreciation. And then when you finish the renovation, you do another cost seg. So yes, you're paying for two cost segs, but ultimately the depreciation that you're getting will outweigh it like by times 10. So I always say if you're doing a heavy lift, do it right away. If not, it doesn't matter. Do it before tax season. Just don't wait too long because cost seg firms get flooded before tax season.
Yep. How does it work for out-of-state investors? Is it the same thing, or is there anything different?
It's a great point. Out-of-state investors generally doesn't make a difference because we're dealing on a federal level. So when it comes to federal, it doesn't make a difference. Now, it's very important to note if you have any New York or California investors, there's something called a state add back. A state add back basically means is that California and New York do not recognize bonus depreciation. I don't know what it means they don't recognize it because it's a federal thing, but they don't recognize it and they actually add it back. So you take $100,000 federal income tax deduction, they'll add it back on the state level. Now, if you're actually able to benefit from the cost seg, it's still worth it because federal you could be at 37.5% and state could be 11%. You're benefiting so much more, you might as well do it. But let's say you're a doctor that cannot benefit from it, so you're not going to take the deductions. What will happen is that the state will still add it back. So if you're from New York or you're from California, you're filing New York and California taxes. There are ways to get out of it. You have to speak to your CPA. If you take accelerated, you don't take bonus. There are ways to maneuver around, but typically there's no difference between, it doesn't matter where you're from unless it's New York or California.
Got it. Cool. Yeah. So we just did a deal called Waverly Manor, and what we did is we engaged with Isaac to kind of run the report, the cost seg report up front, to give us kind of the estimate as to what they thought they could do for us. And we raised 5.1 million for this deal. Is about a $9 million purchase. And for every investor that was in, we ran the math. So if you put in 100,000 the first year, you're going to get 25,000 in depreciation. Then it went to 10,000 year two, then 8,000, and then 6 and 6,000 for years 4 and 5, for a total of about 57,000 in depreciation just for your $100,000 investment. So pretty good overall. When that's just to give you guys an illustration of how it works in real time. So we've already engaged with Isaac, but he's just going to go through and do this. We're doing it early because this is for this year. But like Isaac said, that's a good idea to do that because you're getting ahead of those lifts and the renovations. we'll engage the firm. Then all the investors that came into our deal with those investments will reap the benefits of this. We pass it along to everyone. And then another thing that we do that I saw a question in here about 1031s. And so, yes, you can 1031 and roll into the next deal, especially with Nighthawk. It's something we do that not every syndication group does, is we'll do what's called a drop and swap, where we'll allow people that want to 1031 to 1031 into the next opportunity that we set up. Or if they don't, they can just take their money, their capital gain essentially at the end. And so that's something that we do offer. We've done that a couple times where we'll sell a deal and then we'll allow people that want to roll it into the next opportunity. We'll tee up another one. And that's been pretty cool. A cool thing to do. We also do 1031s in deals too. So
That's actually pretty cool. I want to chime in for 1 second. I want to explain something that Garrett said for a second. First of all, I want to go back when talking about the recapture. If you do 1031 it, then you're able to avoid the recapture. That's a very important thing to note. But Garrett said that if you invested $100,000 in this deal, you're going to get, I think it was $57,000 over 5 years.
mhm.
So just to put things in perspective, first of all, it's going to end up being more because we always outdo our projections. So it's probably going to end up being 60 grand plus for each investor. So if 60 grand of deduction, I'm going to take out my calculator for a second. Let's say the average person on the federal level is paying 30%. Some people more, some people less. So 60 grand times 30% is $18,000. If you invested 100 grand, you did not invest 100 grand. You invested $82,000. And that's why the next deal that Garrett does, you have the ability, obviously you might not have it up front because this is going to come over a few years, but technically you didn't invest 100, you invested 82. That might give you maneuverability to maybe invest a little more. Just keep that in perspective. It's very, very important to know. And then in terms of the 1031s, how you structure those deals, that's pretty cool. I like that.
Yeah. So we're going to move now into a bit of Q&A. I see some questions popping up here. So let's jump over. And so Walter had a kind of a follow-up to what my last statement over here, but just to clarify, to take advantage of cost segregation and depreciation is really best used during a 1031 exchange. Otherwise, you'll be dealing with recapture. I would say yes and no on that. You don't have to 1031 exchange if you have another investment behind it. So if you have another one, if it's your only investment, then yeah, maybe.
Yes, and I'll just add that you have to ask yourself, look yourself in the mirror and say, hey, is it worth it for me to kick the bucket down the road by a few years, even if I'm not going to 1031 it, and I'll pay back the recapture in a few years, but I'm going to be more well capitalized today. I think that's something that's important as well.
Yeah, that's a good point. Let's see, other questions we got here. Said, please explain again that your comment that you can take advantage of bonus depreciation while investing with an SD IRA. So that is a confusing topic for many people.
The IRA is extremely confusing. I want to avoid that right now.
Sure.
There's hot debates going on about different types of investment accounts. And it's something that I have to talk it over with the CPAs again until we get a clear
that's more of a CPA question, honestly. So it just depends on your personal situation with that.
Right.
Let's see, we have another question. How does a passive investor use this as an LP use this cost segregation benefit other than 1031?
He can go ahead and use it against his passive income. If you don't have passive income, it's not going to hurt you. It's a suspended loss, and you just won't do anything. And by the way, if let's say you invested today, and 2 years down the line, while you're still in this deal, you become a real estate professional. Let's say your spouse becomes a realtor, like Garrett said, you can go back and use it. You could take your losses and push it forward to today. So, but ultimately, if you can't benefit, you don't have passive income, you're right. There won't be a benefit.
So I would say the only benefit that you would get if you're W-2 earner, not rep status, is if you have rental properties, you can use it to help offset those passive gains, or actually the syndication that you invested in. You're not going to necessarily have to pay taxes on the cash flow that's coming from that deal while you're in it, because it'll
Exactly.
help
Very well
offset
said.
that. So like people are in money markets right now, it's all taxable, right? So people are like, well, I could just put my money in money market at 5% or 4% right now, it's not really 4% because you have to pay taxes and all that. Now, technically, you owe taxes with the recapture on your investment in real estate, but for now, it's being covered up by any losses that we pick up with depreciation. So you don't have to realize that while you're in the investment.
Well said.
I have a high W-2 and my wife is a rep. If I buy a storage facility for 3 million, how much could I depreciate years 1 through 5? Well, there's a
Every
lot of
property.
variables.
Yeah, there's a lot of variables, but I would say I would feel comfortable to say, based on today's rate of 40% bonus, which basically means of whatever we find, you can take 40% of that. Let's say 3 million. Let's say we say 2.5 is actually building. Let's say 500,000 is considered land. Let's say we would get 15% of that. So 10% would be 250. We're talking about 375. 40% of 375 is a little less than, what is that, 175? Yeah, let's say I would say around 175 year one. But keep in mind that if the parking lot is huge, if there's any special equipment inside the facility, if it goes back to 100% bonus, we're talking about maybe five, six, $700,000. That's why it's very hard to give an actual number. I'm happy to take a look at the actual facility, but you would for sure get that. Even on today's rate of 40%, you would still get a few $100,000, as opposed to probably like 20, 30 each year.
Yep. Let's see. We have a question here that says, what if your W-2 income is from real estate and have passive real estate income from syndications? Well, if you have any kind of passive gains, the depreciation will work to help offset that if it's considered a passive gain.
Yes, but I will add, Garrett, if you have an acquisitions associate, many times CPAs will qualify them as real estate professionals because what they're doing the whole day is doing acquisitions. And therefore, even though they're on a W-2, there's something called W-2 jobs that are qualified for real estate professional status. And then
Yep.
you could completely use anything against any income.
It's really up to what your CPA is comfortable signing off on. So you have to talk to your CPA and say, hey, do I qualify for this? This is what I've been doing. I can clearly show that I'm doing 750 hours with real estate related activity. I'd like to be considered for this. And if they sign off on it, then you're in. As long as they feel comfortable backing that, right? So if you're not sure, talk to your CPA, see what they say about that.
Exactly. Keep in mind, there's no license required for real estate professional status. It's like Garrett said earlier, it's a box on your tax return. And ultimately, the reason why most people don't check it off, if they're not a real estate professional, is because if you ever get audited, you'll get penalized tremendously if you're not a real estate professional.
Right. Cool. Some good questions here, guys. What other questions you guys have? Let's see. What documentation do you need to maintain for, I think you mean rep status. Yeah, rep status.
So ultimately, there's no documentation. The IRS does want to see um, a log. So a guy like Garrett, if he ever came under audit, probably would not need a log. He has a full flourished real estate company with properties under his name. It speaks for itself. But let's say the IRS is skeptical about you. You own one rental, you've invested in a few syndications. They'll want some sort of log. Hey, did you spend those hours at the property or trying to acquire property, speaking to brokers? They do want you to log that out on some sort of system.
To confirm, if you don't have rep status, bonus depreciation cannot offset capital gains from syndicated deals, correct?
It's a hot topic, Garrett. There's a lot of CPAs in the country that view capital gains as passive income, and therefore you'll be good to go even if you're a W-2, not reps. There's a lot of CPAs that hold that capital gains is considered active income, ordinary income, and you cannot. It's a hot topic as well. I've seen it go both ways.
Yeah. From what I've seen generally, it's if you're your bonus depreciation covers up passive gains if you're not a rep, but again, it's really up to your CPA as to how they want to look at it.
How comfortable, how conservative they are, and what they've seen.
Curious, how far can the IRS go back to vet your rep status?
I don't know. I don't know how
I
that
don't know
works.
either. I don't know
I'm
either.
not sure.
It's a good question.
I am not sure how far they back, how far back.
Uh,
I'll just tell you one thing, guys. These IRS agents, a lot of them, they don't know that they don't know a lot of they don't know a lot. We haven't been audited recently, but clients of ours have been audited, and these IRS agents are coming in and saying, "Oh, hey, you guys can't do a cost seg in a residential investment property." And the guy's like, "Oh, yes, you can." They're like, "Oh." So I'm just saying, like, I'm not sure there's any like sort of set of rules by them. I think they've been going through a big like overhaul. Biden hiring a lot of guys, Trump firing a lot. But still, I'm not saying we should cheat the code. Definitely don't cheat the code. But you probably know the tax code better than them.
if I invest in a syndicate deal and out of 100, only 50 are ready for 1031, are there any alternative methods to still take advantage of a 1031? I don't know. I don't know what you mean by that. Honestly, maybe you
Yeah,
could
that's a great
clarify the
question.
question. I'm not sure. Um, so then there's another question. Well, more of a statement here, but passive investors in syndication deals can benefit from one offset other personal passive income. Yes. Save credits for later, i.e., doing real estate professional 72 hours later, offset income from there. I don't know what that 72 hours, what you mean by that, but and then offset rental income. Do I capture every point? Yeah, pretty much. Except number two, I'm not really sure to me. These are good questions, guys. Anything else that we can answer here before we wrap up? Oh, okay. There, she clarified the question. Do we need all 100 members of the LLC from one property to reinvest in the second property, take advantage of the 1031? Very good question. No, it's called a drop and swap. So I can take a portion of, let's say there's 100 investors in a deal. Not everyone wants to do it. I can take a portion. We've done this a few times. There's a legal structure. We can take, like, say 20 of them want to stay, or more, 30. We can take those and 1031 them, and the others can get their money back. That's something that Nighthawk does specifically. Not everybody does that. It's something that we've figured out as far as structuring goes. So K1's from a syndicated deal that sells. Does it separate capital gains from rental income? So it depends. It does depend on that. I would say I would have to ask my CPA exactly how that's formed, but generally, I think it's based on what we're distributing out. So as it distributions, I think they still consider it as a capital gain in there. But I'd have to check. Don't quote me on that. So there's return of capital, and then there's your distributions, which is what you're earning on your capital, right? And so in the beginning, while you're in the deal, your capital's in the deal. We're not returning your capital. We're giving you distributions based on a yield based on what the property is making for you, essentially. So that's what happens first. Then there's a big capital gain at the end. So that's how you make money, is that you're making relatively lower amounts along the way, but it's something you're getting every quarter, which is nice. And then you get your big pop of equity. So you get all your money back, plus you get that gain at the end of the deal when we sell it. Sometimes you can refinance it in the middle, which is nice. Get back a portion of your equity and then go deploy it somewhere else. So we've done that as well, but it's really cool. Does a member have to be all in for a 1031 exchange? For instance, he wants to put in half of his earnings into the next deal. Still consider 1031. So in our specific offerings, we make the person do all of it. So they're either in or they're out, because it just gets too complicated if we're taking a portion on a 1031. So we'll say, hey, if you want to be in, you're going to put all of it. If not, but it just depends. Do we have any investment offerings for non-accredited investors? Not currently. It depends. If you're non-accredited, you can't. There is a way to do that, but we've done it historically, but it doesn't allow you to advertise the deal, which we started advertising our deals more recently. So you have to be accredited with us. The questions keep rolling. Pretty good. When Nighthawk allows people to roll from one deal to the next one as 1031, is there a minimum amount of threshold to qualify? No, there's not. It just depends on what you've invested in the deal, but we can roll anyone. There's not a minimum. Cool. Well, if there's no other questions here, guys, this has been great. Check out Isaac. Why don't you tell people how they can get a hold of you, how they can reach out to you, and
Absolutely. I'm going to put it in the chat box right now, my info, and you guys can save that. I'm very, very active on LinkedIn. My wife makes fun of me that if she wants to get a hold of me, she just DMs me on LinkedIn. But here's my email and phone number. I would love to chat with all of you. And this was a great one. I do this all the time, and you guys had a lot of great questions. So pretty cool. I remember MadisonSPECS.com, and I'll put my phone number in. Definitely reach out. And like I said earlier, Garrett and Nighthawk do nice deals. So there's a dime a dozen when it comes to syndicators, but there's not a dime a dozen when it comes to good syndicators.
awesome. Guys, check Isaac out if you're looking to do your cost seg or have any questions. It's been great seeing all of you today, but we'll catch you guys next time.
Thank you, guys.